According to Investors Business Daily, Palantir Technologies has just hit a fresh 52-week low, and that is setting off alarm bells, as well as opportunities, for investors who follow artificial intelligence and high-growth software names. According to Investors Business Daily News, the article highlights that Palantir shares have fallen more than 30% so far in this calendar year, dragged down by a broader retreat in AI-related stocks and by the pressure of rising interest rates on growth-focused software valuations. Investors Business Daily mentions that this is happening even though Palantir remains a central player in applied AI for government and commercial customers, which raises a key question for investors: is this a broken story, or just a broken stock price creating a potential long-term entry point? In this episode, we will dig into what this new low really means, how the macro backdrop of interest rates and AI sentiment is affecting Palantir, how its business model lines up with the current environment, and what kinds of investors might view this as an opportunity versus a warning sign. According to Investors Business Daily, the stock decline is not occurring in isolation. Many software and AI-linked companies have seen pressure as the initial wave of AI euphoria cools and markets start differentiating between real, monetizable demand and pure hype-driven narratives. For Palantir followers, that backdrop is crucial. Palantir has long positioned itself less as a traditional software vendor and more as an operating system for data-driven decision-making, including AI and machine learning, for governments, defense, and increasingly for commercial enterprises. From the perspective of investors, the new 52-week low forces a reassessment. On one hand, a significant drawdown can indicate deteriorating fundamentals or the market losing confidence in management execution. On the other hand, in cyclical sell-offs, especially when driven by macro factors such as interest rates and sector-wide rotations, it can set up asymmetric opportunities for long-term holders. Let us talk first about the macro environment that Investors Business Daily alludes to, particularly rising interest rates. In financial markets, higher rates tend to compress valuations on growth and software stocks because a large share of their perceived value lies in profits that are expected further in the future. When the risk-free rate rises, those future cash flows are discounted more heavily, lowering the theoretical fair value today. Palantir, as a growth-oriented software company, still emphasizes expansion, product development, and market penetration over maximizing short-term profits. That means a big part of its value story is about future cash flows. In a low-rate world, investors are often willing to pay a premium for that future growth. In a higher-rate world, that premium shrinks, sometimes sharply. According to Investors Business Daily, this macro headwind is combining with a retreat in AI enthusiasm. Over the past couple of years, AI became a powerful narrative across markets. Money flowed quickly into anything branded with AI, from foundational model providers to chip makers to data platforms and application layer companies. Palantir benefited from that association, with many traders and investors viewing it as a pure play on applied AI in security, defense and enterprise analytics. As often happens after a fast run-up in a hot theme, the market then reassessed. Participants began asking which companies have durable competitive advantages, real customer traction, pricing power, and paths to sustained free cash flow. Hype by itself stopped being sufficient. In that environment, even companies with genuine AI capabilities can see their shares decline if expectations had run too far ahead of fundamentals. For Palantir, this distinction between narrative and numbers is critical. Long-term oriented investors will focus on a few key questions. Has Palantir continued to sign meaningful new contracts in both government and commercial segments? Are existing customers expanding usage and spending on the platform over time? Is Palantir turning its AI capabilities, such as its Foundry and AI platform tools, into recurring, high-margin revenue rather than one-off projects? Is the company moving steadily towards stronger profitability and free cash flow generation, even as it invests in growth? According to Investors Business Daily, the recent share price weakness does not necessarily answer any of those questions by itself. Price is a reflection of expectations, emotions and macro conditions as much as fundamentals. So from an investor standpoint, this new low is best viewed as a prompt to revisit the underlying business. Let us step back and consider Palantir's business model in the context of this correction. Palantir earns revenue primarily by providing data integration, analytics, and AI-driven decision support platforms. Historically, the business was heavily weighted toward government and defense, where it built deep relationships but also faced long and sometimes unpredictable procurement cycles. Over time, Palantir has pushed aggressively into the commercial sector, targeting industries such as manufacturing, energy, healthcare, financial services, and logistics. The idea is that as companies drown in data from sensors, operations, and transactions, Palantir's platforms can help them build digital twins, predictive models, and AI-assisted workflows that actually translate data into improvements in cost, reliability, security, and revenue. From a stock investor's angle, that commercial mix matters a lot. Government revenue can be sticky and resilient, especially in defense and intelligence. It can also be politically sensitive and slow or growing. Commercial revenue, by contrast, can grow rapidly once product market fit is strong, but is more exposed to economic cycles and budget tightening. In an environment of rising interest rates, many companies trim discretionary IT and software budgets, prioritize must-have tools, and delay experimental AI projects that lack clear return on investment. That can weigh on Palantir's growth rate, particularly on the commercial side, if customers become more cautious about large, transformative platform deals. At the same time, Palantir's focus on mission-critical use cases could be a buffer. In defense and national security, AI-driven decision support is increasingly seen not as a luxury but as a strategic necessity. For industrials and critical infrastructure, tools that improve uptime, reduce waste, or enhance supply chain resilience can also be seen as must-have, particularly after recent years of disruption. According to Investors Business Daily, investors are grappling with how much of Palantir's revenue fits that must-have profile versus how much is discretionary or still in the experimental category. That perception feeds directly into valuation multiples. The more mission-critical and sticky the revenue is viewed to be, the more comfortable investors may feel paying a premium even in a high-rate environment. Now, let us examine the psychology of a 52-week low for a widely followed stock like Palantir. A new low can have a self-reinforcing impact. Technical-oriented traders often see new lows as a bearish signal and may short the stock or avoid buying, which can add to selling pressure. On the other side, value-oriented or contrarian investors look at 52-week lows as starting points for watch lists. Their approach is less about following momentum and more about asking whether the market has become too pessimistic relative to long-term fundamentals. For Palantir enthusiasts, this divide is important. If your perspective is short-term and momentum-oriented, a new low may justify caution until price stabilizes or reverses. If your perspective is long-term and thesis-driven, the correct response may be to revisit the core story. Is Palantir's competitive position in AI software stronger, weaker, or unchanged compared with 6 or 12 months ago? According to Investors Business Daily News, the recent weakness also reflects a broad shift from growth into more defensive or income-generating assets. When investors become more concerned about macro risks, or can gain attractive yields from bonds and cash-like instruments, some rotate out of higher-risk growth stocks and into safer alternatives. That rotation puts an extra headwind on names like Palantir. Let us frame Palantir's situation through several lenses helpful for equity analysis. First, the competitive landscape in AI and data platforms. Palantir competes directly and indirectly with hyperscale cloud providers, specialized analytics firms, and even open-source or in-house solutions. The question for investors is whether Palantir has a structural edge in terms of technology, security clearance, integration capabilities, and ease of deployment that will allow it to command premium pricing and keep rivals at bay. Second, the durability of government contracts. Defense and intelligence work often runs on multi-year cycles, with extensions and expansions. If Palantir continues to demonstrate its systems are embedded deeply in mission-critical workflows, those revenue streams can justify a good portion of the company's valuation, even if commercial growth is uneven. Third, the scalability of its commercial go-to-market strategy. Palantir has historically used a high-touch, consultant-like model for landing large clients. More recently, it has tried to productize offerings, make them easier to adopt, and expand through partner ecosystems. Investors will be asking whether these efforts are translating into more deals, shorter sales cycles, and higher margins. Fourth, the revenue impact of its AI platform initiatives. As companies around the world experiment with generative AI, predictive models, and autonomous agents, Palantir is positioning itself as an orchestration layer that can connect models to real-world data and operational workflows. The extent to which that strategy drives incremental spend per customer will influence whether today's sell-off is a myth-pricing or a rational adjustment. According to Investors Business Daily, the AI retreat is not just about Palantir. It is about the whole sector moving from hype toward proof. That context can help investors keep perspective. The question is not whether AI as a trend is disappearing. Instead, the question is which companies will translate AI into reliable, recurring revenue and cash flow. From a risk standpoint, Palantir investors should be aware of several key factors that this price action helps emphasize. Regulatory and political risk. Given Palantir's deep involvement with defense, surveillance, and sensitive data, there is always a risk of regulatory changes or political backlash that could affect contracts or constrain growth. Concentration risk. If a meaningful share of revenue comes from a smaller number of large clients or government agencies, the loss or reduction of any major contract could hit the financials and sentiment sharply. Valuation risk. Even after a drawdown, Palantir may still trade at a premium multiple relative to more mature software peers if investors continue to price in strong growth and strategic importance. If growth disappoints, that premium can compress further, pressuring the share price. Execution risk. Palantir needs to execute across multiple fronts at once, hiring and retaining top technical talent, managing complex customer implementations, scaling its commercial engine, and continuously innovating on AI capabilities. On the opportunity side, investors who are constructive on Palantir's long-term potential may see this 52-week low as a chance to accumulate shares at a discount relative to prior periods of AI euphoria. If you believe that governments and large enterprises will continue to adopt AI-infused decision platforms at scale, and that Palantir will remain a key vendor, then a sector-wide correction can be an opportunity rather than a threat. If you have a multi-year time horizon and a tolerance for volatility, you might view current prices as noise against a longer arc of adoption, especially if evidence continues to show customers increasing their usage over time. However, disciplined investors will also consider portfolio construction. It can be risky to let any single speculative or high-growth name become too large a share of overall holdings, especially in a choppy macro environment. Position sizing, diversification, and risk management can matter as much as company-level conviction. According to Investors Business Daily, the sentiment shift around AI also carries behavioral lessons. Markets often swing from over-optimism to over-pessimism. When AI enthusiasm was peaking, many investors were willing to overlook concerns about valuation, competition, and execution. In the current phase, there is a tendency to focus heavily on those risks and discount the opportunities. For Palantir, thoughtful investors will try to resist both extremes. Instead, they can ground their view in facts, contract wins, revenue trends, margin evolution, cash flow, customer retention, and product adoption metrics. They can also track qualitative signals, such as customer case studies, ecosystem partnerships, and the pace of new feature rollouts. Let us turn briefly to the emotional side of holding a stock like Palantir through volatility. For many retail investors, Palantir has become more than a ticker symbol. It represents a broader thesis about national security, data-driven governance, AI-enabled industry, and the future of enterprise software. That attachment can make drawdowns feel especially painful. It can help to remember that markets are forward-looking and often overreact to short-term news. A 52-week low can feel like a verdict, but it is more accurate to see it as a snapshot of collective expectations at a specific moment, under specific macro conditions. For those who hold Palantir, reassessing your original thesis can be constructive. Ask yourself what you believed about the company when you first invested. Has anything changed fundamentally about the technology, competitive positioning, management quality, or industry trends? Are the current headwinds primarily macro and cyclical, or are they signaling deeper issues? According to Investors Business Daily News, the combination of an AI retreat and rising interest rates is the central narrative behind this drawdown. Both are macro variables. Neither is fully within Palantir's control. That means the company is operating under external pressure while trying to showcase internal progress. In the months ahead, upcoming earnings reports, contract announcements, and product updates will be key catalysts. If Palantir can show resilient growth, expanding margins, and strong AI-related demand even in a tougher macro climate, that could help re-anchor expectations and potentially stabilize or reverse the recent trend. If, however, growth decelerates and profitability stalls, the market may continue to re-rate the stock downward, branching from a simple macro-induced sell-off into a more company-specific devaluation. For traders seeking shorter-term opportunities, one approach around a 52-week low is to watch how the stock behaves after this news. Does selling pressure intensify with rising volume, or does the stock find support as long-term buyers step in? Does the broader software and AI sector show similar patterns, or is Palantir underperforming its peers? From a fundamental standpoint, longer-term investors may focus less on exact lows and more on valuation bands and risk-reward profiles. They may use this period to dollar-cost average, to initiate research positions, or to simply observe while waiting for more clarity on fundamentals. According to Investors Business Daily, Palantir's story continues to sit at the intersection of geopolitics, technology, and finance. That complexity is part of what makes the stock so polarizing. Bulls see a strategically vital platform with a long runway in AI-driven decision-making. Bears see a richly valued contractor with lumpy revenues, political risk, and intense competition. Where you land on that spectrum will shape how you interpret a new 52-week low. For some, it is a warning signal to step aside. For others, it is an early sign that sentiment may be overcorrecting and that the market could be underestimating Palantir's resilience and strategic importance. As always, it is crucial to align any decision with your personal risk tolerance, investment horizon, and diversification strategy. No single news event, even a sharp price drop to a new low, should dictate your entire approach. Instead, it can be a catalyst to revisit your research, update your assumptions, and decide whether Palantir still fits within your broader portfolio and conviction set. To wrap up this episode, according to Investors Business Daily, Palantir's latest slide to a 52-week low reflects sector-wide pressures from the cooling of AI enthusiasm and the drag from rising interest rates on growth stock valuations. For investors and enthusiasts of AI and software, it is an important moment to separate narrative from fundamentals, to carefully evaluate both the risks and the potential upside, and to stay disciplined in the face of volatility. Thank you for listening to this deep dive into Palantir's latest move and what it could mean for the future of AI investing. If you found this analysis helpful, consider subscribing and sharing the podcast so you do not miss future episodes.